Rajani from Anurati Wealth, who will be talking about investment strategies in mutual funds. And Shweta, hi, good evening, welcome to the show. So we are talking about contra funds and contra funds, a category where a contrarian view or a bet is taken on sectors and stocks which are significantly on discounted or a fair valuation, something that's out of favor, but then there is a bet for the long term that's been. Primarily, it invests in equity market as far as the fund allocation or portfolio is concerned. But having said that, because we're talking about something that's out of favor or something that has more value and a contrarian view, it sounds. The tone of it sounds slightly risky and very different from the rest of the well-diversified mutual funds that we usually see or people invest in. Is that the right way to look at contra funds? Because it's a very concentrated bet and the kind of strategy that is being offered through contra funds.
Good evening. Kavita, like you said, the name sounds as if, you're going into risky bets of the portfolio because you're going in a direction which is opposite to what the market is buying. You're buying underpriced, out of flavor stocks in your portfolio. But, actually, if you go to look at the underlying portfolio, even if you are investing in a contra fund, the fund manager is not necessarily investing 100% of the portfolio in contrarian bets. What it means is maybe 75% of the portfolio is a contrarian bet and 25% odd of the portfolio is still, kind of balancing it out. Second, a contra doesn't mean necessarily concentrated holdings in the portfolio. So you might find that, even contra funds are well diversified with someone having 60 70 stocks in the portfolio. So just let me give you some numbers and perspective here. There are only 3 contra funds today in the category because as of date SEBI says you can have either a contra or a value fund. So you have 3 contra funds and the AUM there is around 70,000 crores. These funds in terms of their stocks are diversified. In terms of their market cap allocations, they have like an average 60 large, 40 mid small in the portfolio. Beta, which is a risk measure, which tells you in terms of a relative risk, let's say to a broader benchmark of Nifty 50, these funds run a beta of anywhere between a 0.88 to a 0.95, which means the beta is less than 1, and therefore they are less riskier than a Nifty 50, which is, the key benchmark and supposedly a very diversified basket. So yeah, contra fund not necessarily very high in terms of risk when you statistically measure it, but it may need a longer time horizon. So in short periods, it may not play out like any other diversified fund. You may have to spend a little more time being invested in a contra fund to get the returns that you would have expected it to deliver.
Since we just have 3 funds, 3 contra category funds now, what is a typical portfolio like of these funds? I mean, one of them is very famous SBI Contra that we usually see also, and people, investors, it's one of the favorite ones. Having said that, I want to understand the kind of portfolio that these funds have currently, and also because we're talking about a diversified approach, because we're talking about somewhat like a value approach, contra fund can be compared to what, a large cap, if I want to just compare in terms of return and in terms of the portfolio culture, what kind of comparison would be right?
Sure. So, just talking about basic portfolio statistics, these are funds which would have anywhere between, 50 to 70 stocks in their portfolio. In terms of their market cap split, there would be anywhere between, the 3 funds range between 60 to 65, kind of a large cap. You would have maybe another 20-25% of mid cap in the portfolio, and let's say 15 odd percent of small cap. So which is where the broader split is 60 large, 40 mid, small. Not 100% portfolio is contra. Anywhere between 65 to 75% of the portfolio would be contrarian bets. So, you may see something like Swiggy or an Eternal, which right now, clearly in terms of profitability may not showing profits, but there's a cycle that's likely to play out. So that's how the portfolio split would be. You also mentioned about value. Yes, they are very similar to value, but they are also different in a lot of ways. What a value fund does is it will look at certain valuation matrix like a PE, PB, and then see which companies are undervalued and invest in those. Contra, on the other hand, may be investing in an undervalued company, or it may be investing in a fairly priced company, but right now it is out of flavor. It could be a sector which is not being looked at, but in terms of valuations, it's not necessarily a cheap sector. So that's where your contra was slightly from value, and therefore it may need a little more time period, because for that cycle to start playing out may take longer than a value fund or a value style to play out. So therefore, for these three contra funds, if you compare the PE of the fund, may actually be a little more than the value fund that you see. So that's a minor difference between contra and value. Again, if you compare from a performance standpoint, contra, there are periods where value does better than contra, but if I have to look at longer time periods, contra seems to have a slightly better performance than value as a whole, because it's more diversified as compared to value.
All right, so I'm looking at Invesco, Kotak Contra, and I'm looking at SBI Contra. In last 2 years, I can see the returns ranging from 25% to 20%. I mean, Invesco around at 25, Kotak 23, and SBI Contra is at 20. And similarly, in last so the 5 years return. Oh, that's fantastic. That's SBI Contra again giving you 32%. Kotak Contra is 25 and Invesco again is 24. I'm looking at direct plans over here. Okay, so typically what's the kind of portfolio these three funds have? If you can just give me some exposure in terms of sectors or the areas where they are heavyweight right now in the portfolio.
Sure. So I'll just talk about certain common names which you may find in all the three portfolios. And there, like I said, you'll find some of the common benchmark names as well. So these are not necessarily a contra play, but because these are benchmark holdings, some portion of they are being maintained to manage from a risk standpoint. So you'd see something like an HDFC, Reliance, ICICI, the top common holdings, which is there in a normal diversified fund as well. But on the other hand, you could also see names like an Airtel, Ultratech, like I mentioned, Swiggy, Eternal, Poonawalla, maybe a Biocon. So those are kind of names that you see in terms of sector split. If you talk about, so, here again, you'll find a little bit of pharma, you'll find the new age companies, you'll find a little bit of financial services, may not be the necessarily the top private banks, but you're playing it out through some bit of the financial institutions over here. You'll find a little bit of real estate. Those are the kind of whole sectors you would find. So if you just look at a pure sector classification, you may not be able to differentiate much between a diversified and a contra fund. So anyone who's evaluating contra as a strategy also would have to get detailed into the underlying stock holding to figure out what's really the contra play and how it could be different than a diversified fund.
Let's talk about risk. What are the risks associated with the contra category?
So, see, risk one clearly is that you may have expected that a certain cycle may play out in the next 8-9 months, but it may get extended, which is where you'll have to be more patient in a contra fund as compared to a diversified fund. So that's one major risk, I would say, that if you are expecting that a contra fund may play out in year one, it may not happen. You'll have to give it 2-3 years to play out. Second is because this is contra, if it works well, it would work well. If it doesn't, that if few of your contra calls have gone wrong and you're maintaining a concentrated holding towards that, that is another risk that one could see. But thankfully, we have the three fund managers that we have today have very well managed the concentration risk of the portfolio.
Now, I just want to understand the portfolio placement of contra funds. Now, since it is a very well diversified category again, just to avoid over diversification and repetition of investment in your portfolio, how can one actually place it in their portfolio and align them with their financial goals?
Sure. So, one needs to have a very well balanced portfolio, and therefore it is important to get a good blend of one, different market caps, but also different styles of fund management. So you can have, a growth oriented style, a value style, a dividend yield, a contra. A portfolio should have a blend of all these, and therefore from a allocation standpoint, having a 5 to 8% allocation to a contra fund in the portfolio definitely makes sense, I would say. Therefore, can it contribute little more than what a diversified fund in certain pockets? Yes, it can. Risk, it may not necessarily be adding too much risk to your portfolio. So therefore, yeah, 5 to 7% allocation.
All right, so that's all about contra funds and the right way to look at them. And out of three, which one would you recommend and why?
So, I would say while each one of them have had their cycles and they're good, but if I have to pick one, I would go with I think what the market choice also is an SBI Contra fund. Because if you rank it in terms of consistency and the track record, that clearly comes up better than the other two that we have.
Move on, and I think that was all about contra funds, but now it's time to get connected and let's talk to our viewers. In fact, let's get their portfolio queries answered. And for all the viewers who are just waiting for our WhatsApp number, email ID, or any source through which you can reach out, let's flash our WhatsApp number and email ID on screen so that you can note it down and send us all the details, your existing investment details, and anywhere where you to invest or any goal alignment strategy that you might want from our experts. You can send across your questions and we do your life financial planning on the show. Shweta, let's move on and let's take Nisha Barot's question. She's from Mumbai, and she says that her current SIP portfolio is 10,000 in each of the funds that she's mentioned. She's investing since Jan 2025 and she wants to invest lump sum 10 lakhs also for 5 to 7 years. She wants to add another 30,000 in existing SIP, and she wants to know if any changes required in the current scheme. So the schemes are Motilal Oswal large and mid cap. She's got Kotak multi cap, Parag Parikh flexi cap, Nippon small cap, ICICI Pru value discovery, ICICI Pru large and mid cap again. So a check on the funds. She wants to add another 30,000 to this and also a 10 lakh lump sum investment for 5 to 7 years. Although the SIP that she is doing, I'm not very sure of the time frame, but let's assume even these SIPs are for 5 to 7 years, Shweta.
Sure. So Nisha, I did go through your portfolio, and I have to say that it's balanced in a certain way. Maybe a little more mid-small allocation can be added to the portfolio. Most of the schemes that you have are also good. You can continue with them. I just have one suggestion that you should stop your SIP in Nippon Small Cap Fund, and instead, I'm recommending you 5 schemes that you can add. So your existing SIP, what you are doing, continue in your existing schemes. The 10 lakh additional lump sum that you have to do can go in the new schemes that I am telling you. Instead of Nippon small cap, the SIP that you are doing, you will be stopping that, and that you can invest in an Invesco small cap fund. The other schemes that I suggest to you are SBI Contra, HDFC Flexi, Canara Robeco Multicap, and Kotak Emerging. So your portfolio right now has more of large and mid flexi kind of categories. I'm trying to balance that out by adding a little bit of multi small in the portfolio.
Okay. All right. So that's the solution for Nisha. And okay, let's move on and let's take Chaitanya's question. He's from Hyderabad, and he wants to sell the equity portfolio and then invest into mutual funds as one-time investment. He has around 12 crores to invest. I think he's got a stock portfolio and that he wants to sell out entirely and then start investing in mutual funds. Amount is 12 CR. I'm not sure of the time frame, but it has to be a one-time investment. All right, a lot of things to advise Chaitanya. Let's go with doing a one-time investment. How good or bad it is?
Sure. So in Chaitanya's situation, since this is a direct equity portfolio, this is money which is already invested in the market. It's not a fresh cash infusion that Chaitanya is doing. It's just that we are shifting from one product category to another product category. Therefore, I would say a one-time investment should be good. It's just that, it's there in the equity market, just going from one part to another part. So therefore, too much of an SIP may not be required because it means you're getting out of the market and then staggering your investment. At best, if you want to do maybe a 2-3 installments of you moving from direct equity in tranches and going into mutual funds. So that's one piece of advice to you, that you don't have to worry about timing it. It's not fresh infusion. Second, Chaitanya, actually a decision may be a good one of shifting from stocks to a professionally managed mutual fund. In our own experience, we've seen investors who generally don't have the time and bandwidth to research each and every company are good with giving it to professional fund managers. It's a 12 CR portfolio, so I would suggest a portfolio of around 7 to 8 schemes that you build in. Right now, I'm maintaining a balance of around 50 large and 50 to 55 large, and the rest of it being mid and small cap for you, because I'm assuming you have a longer time horizon. The schemes are SBI large and mid, HDFC Flexi, Kotak Emerging, again, Canara Robeco Multi-Cap, ICICI Pru Focus Equity, SBI Contra, and ICICI Pru Dividend Yield. So these are the schemes. You do it in an equal proportion. You will get to the market cap mix I mentioned to you. But in a mutual fund, it's important that you do an annual review of the portfolio and see if these funds still hold good or you need to change them. So after a year of investment, do a thorough check on the portfolio. That's, I think, Chaitanya, my recommendation to you.
One question to you. I also want to know what about having both strategies? You're investing in equity via mutual fund, you're investing in equity via direct stocks. Why is that kind of a portfolio a no-go? Or it's okay, you should just be aware of the kind of risk that you're taking?
Absolutely. So see, if you're going in a stock portfolio, if you are managing it very well, if you are tracking it, you know what's happening with the underlying fundamentals of the company, you can have a diversified portfolio and manage risks well too. But most often than not, I've seen investors not having the time or the expertise to do that kind of a review and tracking for the stock portfolio, which is why leaving it to a professional fund manager who is having a team of each fund manager having a team of 8 to 10 analysts and risk managers for the portfolio can do it in a better fashion than most direct equity investors would do. But just like I mentioned, if you have the expertise and the knowledge, then a stock portfolio may also help you beat that index by 3-4%, which you would expect a mutual fund to do.
All right, so you also recommended the funds which you should be starting off and stagger the investment amount. Okay, a bit of clarity would have really helped, we could have strategized it better. But then, yeah, let's move on. Let's take Chiru's question. Could you suggest best flexi cap for long term for next 30 years and that will perform well? Also a small cap for long term. Which one we should choose based on NAV value or performance return? So he's given some example of flexi cap, which is HDFC flexi cap NAV, and he's talking about Parag Parikh flexi cap NAV. Okay, so the value is for a portfolio NAV points that he's holding, or the value is for the amount of money that's invested in AMC's fund house. Okay, interesting question. Let's answer NAV part first in his question, and I think that will be advisable for a lot of other investors also. So yeah, how should we actually look at NAVs of a fund?
Yes, this is actually a very interesting question because, people and especially new investors often tend to get confused when they look at, NAVs versus looking at the portfolio return. Now, NAV is nothing but its net asset value. Just like a stock has price, a mutual fund has a NAV. Okay, so that's the price at which you're entering into a mutual fund. But a lot of the times what happens is we see stocks being at 52-week high or new peaks, and therefore we wait for the stock price to correct and then invest in it. The same logic does not necessarily apply for a mutual fund, because let's say in a mutual fund there are underlying 20 stocks. The performance of those 20 stocks gets converted into a net asset value. a fund will always touch newer peaks or newer highs because the 20 underlying stock does not remain constant. The fund manager keeps churning this portfolio, and therefore, stocks which have done well, where the future potential may not be so great, kind of move out of the portfolio and new stocks enter into the portfolio. So, that's one reason that NAV, while it's used to compute the return, the pure value of the NAV should not be a decision making factor, right? Because a fund, like you've given the example of an HDFC Flexi, even at a 2000 NAV for the last 5 years, if you look at it in the Flexi Cap category, has been among the top 3, 4 performing schemes. So therefore, NAV doesn't really matter much. You should look at what the underlying holdings are and what is the growth potential of that. Returns, of course, is something that, one variable which everybody should look at, but the decision to invest again should not be solely based on the past return, but more in terms of consistency of return, risk management capability of the fund manager, and stock picking capability of the fund manager. So to answer your question, look at these factors than the NAV, when you're taking the investment decision. I think also you asked for which fund in the flexi cap category. So while
For next
I'll
30
give
years,
you
flexi cap for next 30 years, and he also wants a recommendation in a best small cap fund.
yes. So in the flexi cap category, you can go ahead with an HDFC flexi cap fund. Given that it's had a long-term track record, irrespective of what the size is today, where the NAV is today, the fund and the fund manager's capability has shown that over long time periods it's been a consistent performer. So that's one. In the small cap category, you can go in for an Invesco small cap fund over here. However, I would say when you're constructing a portfolio, please do construct a portfolio which has few other categories as well. So you need to have a mid cap fund, a large and mid cap fund, maybe the contra fund, a focus fund in the portfolio, and have a balance of different styles and categories in your portfolio.
Okay, so I think that answers it all, and with that, it's a wrap on the show as well. Thank you so much, Shweta, for taking time out and helping our viewers with their investment strategies and also the understanding on contra funds today. Thank you so much. And for all our viewers, I'm going to sign off, but I'm going to leave you with our WhatsApp number and email ID because it's important for you to reach out to us if in case you have any doubts on your financial strategies or investments or anything that you want our experts to help you with. Do send across your questions on our WhatsApp number and email ID. Thank you so much for watching. Goodbye.